London share prices dropped more than 200 points today with fears of a sharp recession on traders' minds. Small businesses are worried too about a squeeze on their finances from the banks. Their representatives met ministers today and said that they've been given assurances that the banks, backed by the state, will keep money flowing to small companies. But the Bank of England's been outlining its new plans to support the financial system, and its message seemed to be that it will remain tough to borrow. Here's our economics correspondent, Faisal Islam.
Far away from the plummeting stock markets, ordinary businesses like Cobalt, Blue and Farnham are also concerned that a £2 trillion global bailout, the world's biggest international rescue, isn't working, not yet rescuing them as their overdraft rates continue to surge.
For us, getting the cost of raising the interest rates is up to 16%, which is nearly the same as a credit card. So it's penalising us a lot. We're getting about £1,500 or more a year in terms of being charged for using the same borrowing facility.
That concern was carried to business ministers today, the urgent message that state-controlled banks need to be forced to fund small businesses.
The era of cheap credit is at its end, but what we have got a commitment from the government that they will make an annual statement to Parliament and in effect a report on how the banks have dealt with the situation and whether they're using the money that they've put in a responsible way. So we've got that commitment, which is very, very good, so we can see whether in fact their track record is living up to the commitments that they may have given to the government.
So if they don't do it, you can shame them into action?
Well, yes, absolutely, because they are part of the country and we have to all pull together.
With a host of banks heading for part nationalisation, the pressure's on from various quarters of the economy for the government to be less arm's length and more strong arm. Even the terms of the bailout itself, specifically the ban on dividends being paid by banks in receipt of government support, appear to be being weakened after the bank's shares were heavily sold by investors. But it's the support a part nationalised banking system can and should give to business and industry that's key. The Bank of England tried to do its bit to free up clogged up money markets today with a radical reform to how it supports banks starting on Monday. This will be a permanent successor to the first attempt at a bailout, the so-called special liquidity scheme, which banks can only use till January. Banks have been stuck holding mortgage-backed securities, huge packages of mortgage debt, after the credit crunch halted their trade. Recently they've been allowed to effectively pawn them at the Bank of England in a 3-year swap for UK government bonds, much more reliable and so strengthening their financial position. But so far they could only take in mortgages issued up to the end of 2007, so that facility did nothing to boost current mortgage lending. But now the Bank of England will swap new mortgages onto its books, but only for 30 days. That's the message of the bank's reform paper released today. Imagine that the bank bailout works perfectly. Even then, an arcane and technical document like this has some fundamental realities. That after a month of turmoil in the markets, Mervyn King and the Bank of England believe that their relationship with the banking system remains the same, that of backstop. But it isn't some magical fountain of credit ready to restore the levels of mortgage and credit card availability to that of 2007. And that's because parts of the banking system that we think of as not working may well have changed fundamentally, and that's a structural increase in the price of credit for us all. The FTSE 100 fell dramatically again today, down to a 5.5-year low. Fears about recession and about the bailouts not yet kicking in, but at the highest parts of the banking system there's a growing belief that the free flow of money, of unsecured lending between our banks, may be permanently lower in this new world. That's going to have a huge impact on the interbank interest rates that are key to setting the price of credit across the economy. Bank of England base rate in January 2007 was 5.25%, while the 3-month interbank rate was just over 5.5%, a narrow gap of 1/3%. Today the Bank of England rate is down to 4.5%, while the rate between banks is higher at 6.2%, a margin of nearly 1.7%, and though the gap may close, it's not going to close completely. So a different picture of credit availability from the Bank of England to that suggested by the new part owners of our commercial banks. Now, the Bank of England is owned by the state, but doesn't always do what the government says because it must remain independent. But now the government's got stakes in other commercial banks like RBS. What today shows is that the political pressure to interfere in them has only just begun. Faisal Islam, Channel 4 News, outside the Bank of England.
Well, as you just heard, it was a bad day for the markets. The index of 100 leading shares was down by more than 200 points. That's 10% down in 2 days. Short time ago, the pound was up against the dollar by 0.75 cents. Sterling also up against the euro by more than a cent. Well, the Minister for Competitiveness and Small Business, Shriti Vadera, joins us now from Westminster. Shriti Vadera, the thing that everybody is perplexed by is how you will persuade, force, cajole the banks that you now have a stake in to actually ease the credit flow.
Well, what the Prime Minister and the Chancellor announced was a comprehensive package that gives banks adequate liquidity and adequate capital that enables them to resume lending, particularly for mortgages and for small and medium enterprises. It's not an issue of cajoling or forcing them, but it's ensuring that we have actually stabilized the financial system so they themselves can access funds and do the job that they're meant to do in the economy, which is recycle money and lend our savings onto small businesses. And that's what this package is about. And it's not something that's going to kick in immediately. It's literally just been announced and is being worked through, and the money will be injected. And then we will have to see what happens to the market. So people shouldn't be expecting, looking at the stock market today, that this is the immediate impact of it.
But how will you tell what's going on? Will you have targets? Will you have some test by which people will be able to see whether they're doing what the taxpayer wants them to do?
Well, what they've committed to for the banks that came to the government for equity is that they will make available and actively market lending for mortgages and small businesses at 2007 levels. That doesn't mean that they will lend the absolute amount. They're not required to lend the 2007 levels, but they have the capital and the liquidity available to do that, to show that they're open for businesses. Of course, whether or not they do will also depend on the credit risk of the businesses, and we're not going to be forcing banks to do something that would be reckless or irresponsible in their lending.
But you see, in hearing that, a number of small businesses will be saying to themselves, well, now I can look forward to being able to borrow the same amount I was able to borrow last year. But there's no real evidence that that will be the case.
Well, we will be monitoring, and as John Wright said earlier in your programme, we'll be monitoring what the banks are doing. They are to report to us annually. We will be reporting to Parliament annually, and we do in fact monitor these figures very closely indeed, so we will be able to tell the trends that are available. But of course, as as their own cost of funds increases, the problem that has arisen is that they're seeking to pass that on to small businesses. And so what we're going to do is to track everything to make sure that on the one hand there's no irresponsible lending, and on the other hand there is availability of funding at competitive prices. But
it's a very tight window of opportunity, isn't it? I mean, many of these businesses can't hang around for long for this to kick in. Will they be, for example, able to come to you and say, look, we're not being lent the money that you said we would be lent?
We certainly have an open door in terms of dialogue, and we had a very good discussion today with small businesses that you mentioned. We have a couple of government schemes, and in fact in the budget, partly in preparation for this, we announced an increase in our scheme for small firms, where we guarantee 75% of the credit for small firms who don't have the collateral to give to banks. We're also working with the European Investment Bank and our own banks to apply for funding of about £1 billion, which will be lent via our banks to small and medium enterprises. So as a government we will do everything that we can, but really the main source of capital will of course remain the UK banking system, and what we've done and we're trying to do is strengthen that and make it one of the best capitalised, amongst the best capitalised in the world, which is able to fulfil its function.
We're just going into November, and well, I mean, we've got a couple of weeks to go, but I mean, we're going into the Christmas buying period. What are people to do? I mean, put it on the credit card, or break with what they were doing last Christmas and begin seriously to tighten their belts?
Well, let's be clear that actually, if you look at the current lending levels, it has only just very slightly started to dip, and we haven't seen a dip in the early part of this year at all, and the early part of this year we had lending levels very similar to last year. So there's only just begun to be a tightening. I think that we've taken decisive action to try and reduce the cost of funds to banks between themselves, which can then be passed on to borrowers. And also we've acted decisively across the world, because this is not, we have to remember, this is a global crisis. This is not just about UK banks. We could have done what we did in isolation and it wouldn't have worked as effectively.
Shriti Vadera, thank you very much indeed for joining us. Thank you.